Hello and welcome to this IG Bank webinar series on options trading. Today we're going to share with you an overview of what options are, how you can trade them using IG Bank, and also a little bit more just about IG Bank and also addressing any questions you may have regarding our platform and trading options with us. So thank you all for joining this webinar. The first thing we have to do is just look at this disclaimer. I ask you to just take a moment to make sure that you read this disclaimer and that you're aware of all the risks and understand the risks involved with CFD trading. Okay, if you would like to see the disclaimer again later, you can just email us and we're happy to share that with you as well. But at this stage, I think we will start our webinar. So first of all, welcome to IG Bank and thank you for joining. A little bit about IG Bank. We are a Swiss bank, but also a trading platform where you can trade CFDs, options, and futures. So what you can find with us is a variety of different markets. We offer up to 17,000 plus markets. So there's countless opportunities for trading from index to Forex, commodities, shares, cryptos, and various other markets. We have platforms available that are on web and also on mobile, as well as integrations with L2 Dealer, Pro Realtime, and MetaTrader 4. And of course, we also pride ourselves on our customer support, which means that we're available around the clock for our clients 24 hours a day. And we also offer a variety of interactive education and a vast range of tools and data for our clients, as well as analysis on the various different markets. And if you would like to open an account with us, you can do this directly over our website, or you can also trial our free demo account. At this point, I would like to give the control to my co-host, Dunja Geschließer, who is our premium client manager and also an expert on options. So she's going to give you a little introduction into options and explain how you can trade these on our platform. If at any stage you have any questions, please feel free to write those into the chat. We'll be looking in there frequently to make sure we address all of your concerns. So thank you so much for listening, and I will pass on to Dunja.
So hello everybody, a very warm welcome from my side as well. I hope you're all seeing my screen by now. So my name is Dunja Geschließer and I am one of two premium client managers at IG Bank. Today we'll focus on how to trade CFD options via our IG platform. And I see that there are a lot of people who joined now, so thank you very much for taking the time today at 11 a.m. So as the audience's level of know-how in this regard might be rather diverse, I will try to keep it not too simple, but also won't go too much into the details, such as how options are priced and so on, but to really give you an overview with a couple of information and then going straight into the platform. So I will be assuming that you all know what an option is and that there are calls and puts and that you can buy or sell them or so-called write them as well. But again, I will be showing also a couple of examples. And I would like to start today with a couple of slides first, and then we will move to the platform itself. I think that will take in total around 30 minutes. And of course, always happy to have a Q&A session afterwards. So as Julia has already mentioned, do feel free to send your questions via the chat box, and I will try to also have a look while we're going through the presentation. All right, so let's get started. The disclaimer, you've already seen it before. For those who missed it, here again, CFDs are leverage products. Do feel free to go back there afterwards. Let's get started. Very quickly, as already heard, we are two premium client managers. We are based in Zurich at Paradeplatz in Switzerland. There's myself on the left side, Dunja Geschließer, and my colleague Enk Lien. We're two PCMs here, or so-called premium client managers. We both have an investment banking background, actually, with an experience of each of 7 to 9 years within the industry. My colleague Enk's focus has been mainly structured products, while myself, I have been amongst different asset classes looking also at OTC interest rate derivatives. Apologies for that. We both worked at different banks in Switzerland. Lastly, before joining IG, we were at one of the biggest banks here in Switzerland, also at Paradeplatz. And yes, with this expertise that we're bringing to the ground, we're very happy to assist you. Now, I don't want to bore you further with our profiles, but actually get into the topic itself with options. Let's start with my 3 slides that I want to present before we open the platform. All right, so I wanted to show you actually 4 different points that I've put together on why to trade options. Some of them might be very, let's say, straightforward to you, but just to run you through again. So number 1 being leverage. Of course, buying options can offer you significant leverage, whereby you actually get a position similar to the underlying, which can be then obtained, but at a significantly reduced initial outlay. The second point being a predefined payoff profile. So whenever you enter into an option, you always know what your payoff profile is, whether it's a single line option that you're entering, whether it's a strategy, you always know what is your loss and your profit profile. So very quickly, when you're buying an option, you always know your worst case, because when buying an option, you pay a premium, which equals your max loss. While the upside is unlimited, of course, if market goes in your direction. While on the other side, when you are selling an option, the loss can be unlimited, so it's the opposite profile, while your maximum profit is the received premium. You always know what your received premium is because that's the premium you actually select according to your strike via the option chain. We will be looking at that later on. Then point number 3, that's hedging. One sec, please. I'm just going to take a sip because my voice seems to be a bit bumpy. All right, hedging. The use of options can be there to lock in a potential gain or minimize losses should the market not go as you expect. Here, maybe a quick example. So let's assume that you're actually having a long Apple position in your portfolio. So that's already an open position. When you're long, you of course hope the prices go up, and now you're unsure where the market is going because there are some, let's say, earnings news that are upcoming, and you might expect some volatility to come in and you want to be hedged. So one of the options, or let's say one of the strategies to hedge yourself could be via an option. In this scenario, you would buy the protection against a downside move by being long a put on the Apple stock with a specified expiry and a strike. This put gives you then the opportunity to sell at the defined strike at expiry. So your maximum loss profile here would be, of course, the premium that you paid for this put. So this on hedging. Coming to the 4th point, flexibility. Of course, you can trade wide numbers of strategies that suit your outlook, being bullish, bearish, or neutral. And we will be looking also into one strategy that I will be demonstrating via the platform. All right, let's come to my last slide before we go to the platform itself. CFD options. A lot of clients probably know what vanilla options are and have traded maybe vanilla options at other places, but they sometimes get a bit confused and think that CFD options are something completely different. That's not the case. So in theory, by the book, the CFD option works exactly the same. There are just a couple of differences which are important to highlight, while again, your strategy that you've been performing with your usual options trading is the same. So for CFD options, what are those points which are important to highlight? They are being cash settled only always at expiry, meaning you will never get any physical delivery. So let's assume you're actually buying an option, for example, on a commodity, and for other, let's say, providers, you might be able to also ask for physical delivery. In IG's case, you will always get cash. You will never get like a bucket of rice or anything else delivered to you. Then the second point, IG charge, that's always embedded via the spread. So it's rather transparent. You always know what you're paying as a fee. You have, of course, a huge access to a big range of markets. We'll be seeing that a lot later on. So you can trade it on shares, on FX, on indices, and so on. IG on the CFD options that we provide, we actually give different expiries. So you can have the 0 DTEs or so-called daily options. So they expire within the day. We have weekly and also monthly expiries. You might know the monthly expiries from, let's say, the listed options side. Given here everything is OTC, you have different expiries that you can choose from. And lastly, there is no automatic rollover, as you might know that from trading futures, which can also be used, of course, for trading or for hedging purposes. So in this case, if you do not close your position pre-expiry, you're at expiry, we just cash settle, and it's up to you to open a new position manually yourself. Good, let's go into the platform. Let me bring in the platform in here. I've already opened my demo, and before we actually dig in, it's very important to say that everything I am going to show is just for demonstration only, and it's not an actual trading recommendation or an action point. So I will be showing examples, but they're really just example based and not something, let's say, as an action point or tradable. Good, let's look at this platform here first. Most of you probably know it already. On the left-hand side, you see all our products always for CFD that you can trade as an underlying, and you will be seeing at the left-hand side at the bottom options. So let's open this first. As you can see, you can always select your asset class, let's say indices, and you can already pre-filter according to your maturity. Let's take, for example, the daily option. Then you see all the instruments that we are actually providing, and let's take one of the main hours already. Let's take the DAX here, the daily one. Okay, what pops up here is now the so-called overview with the option chains. So just a very brief overview, what you can see, you always have the underlying here, the DAX, or as we call it, Germany 40. You have the expiry, daily, also visible here. In case you actually wanted to have a different expiry, go to the drop down and change instantly or filter it backwards on this side. You have your call and put option chains with the premiums if you sell or buy. The strike is being in the middle. This black line here shows where the current market price of the DAX, the spot price, actually lies between those strike prices. So of course it pops as the price is moving. This also gives you always an indication for the calls and puts, whether you're at the money, in the money, or out of the money. Lastly, what you can see is the so-called IV, the implied volatility, one of the famous and important Greeks that you probably also want to look into. All right, so let's make a simple example first, and then later on let's look into a strategy. So how do you place an options trade? Let's assume again that you are having a long position in the DAX, given that we're looking at the daily one. So long position means you think that or you hope that the market goes up, but again, you do think there is some volatility coming in, and what you want to do is you want to actually protect yourself against the downside. So what we would do in this scenario is we would go long or buy a put, because that actually gives you the possibility to profit once the price goes down, to make up for the loss of your long position. Okay, how do we do that? Let's say we see that this is the current DAX price, and we're now looking for a strike, which shows us, okay, at which level would we be allowed to sell and actually be hedged. I'm going to take something out of the money so that my premium that I'm going to pay is not very high. Out of the money for buying a put would be in this range, the upper end of this black line. In the money would be above. Why? Of course, if I am allowed to sell at a price which is higher than the current market price, I'm already inside the money and it would already have an intrinsic value. Okay, let's take, for example, strike 17,780. So I am saying, okay, if prices drop until 80, I am okay to take a loss. As of then, I want to be protected. So I want to buy the right to sell at expiry my DAX at 17,780. For that, I am paying this premium, 42.4 per point. All right, let's see it here in the deal ticket. I have my strike here. I have my long put position, and I'm going to add one contract. Important, you already see here predefined one contract is a €5 per point, meaning if you trade one contract, your premium you're going to pay is 5 times 42.2, which in this specific scenario also equals to your margin because your maximum loss is the premium paid. Here, in this case, as said, you would be paying a premium of 210 or 211 approximately. All right, now you might ask yourself, what is my break even? Your break even would be your strike, the 17,780 minus the premium paid. So this level minus your roughly 210, that would give 17,570 as the break even, meaning the price has dropped so much in your favor on the put option that you even made up for your premium that you had to pay upfront. Okay, so maybe now your question arises, all right, if I actually have this DAX position in my portfolio and I want to open such a put position, long put position, how do I actually know how many contracts I need to buy on the option side in order to have a full exposure hedge or even a partial one? How do I calculate that? What I always like to do is create a workspace. So if you add this overview, add to workspace, you will be getting an overview. Here you can create different workspaces, and what I've done is I added the options overview, and I also added, by going on the DAX, click add to workspace, to the same workspace, two different charts next to each other. You can align them the way you want, and what we'll be seeing here is the current Germany DAX as well as the options. So here I just have the cash contract because obviously we're looking at the daily, so this is being featured against the cash. Let's take the €1 per point contract, and let's assume that in your portfolio right now you have 5 long positions. So let's say this is already in your portfolio, this trade, 5 long, €1 per point. Okay, what you see straight here is this is your notional, roughly 89K, and your exposure is €5 per point. Obviously, why? Because 5 contracts times €1 per point gives you €5 per point. Okay, this is the exposure you want to match on the option side. As you can see here, one contract already equals 5 per point, meaning to equal 5 here and 5 here, you would only go long one put of one contract in order to have the full exposure. If you want to only have a partial hedge of half of your notional, being roughly 45K euros, you would of course here only trade 0.5 to get the half per point exposure. Careful, minimum size is 1, so for this one it would be too small. Let's make a very quick different other example. If you're having 10 DAX positions long, again, we assume this is already in your portfolio, you are having an exposure now of €10 per point. Again, we know that on the option side, it's €5 per point per contract. In this case, we need to take 2 in order to have the full hedge, €10 per point versus €10 per point. Maybe a very quick one here in the info sheet. It's always a very important and good button. You always see here what your contract size per point is, so you also know your multiplier when defining how many options you need for hedging purposes. On the option side, maybe lastly, you always have your code here, and under expiry, you also see what is the last dealing date, when is the expiry. So in this case, of course, it's a daily one, so it's going to be today. All right, let's continue here. So as you know, if you take a position on the DAX, you can always go only directional, right? You buy and you think the market goes up, or you sell and you think the market goes down. Of course, you can take both positions together if you do a force open and have them both in your positions to lock in your price or do something else. But in the end, you're always being directional if you're not having a fully hedged position. With options, you can actually combine those options and build strategies out of it. So what I want to show you today is one strategy. Of course, there are many different ones, but just to showcase how you would do that via the platform, including a couple of calculations. So the strategy I will present today is so-called bull call spread. It consists of two different legs, number one being a long call with a lower strike, and number two leg being short call with a higher strike. So let's do this together here again based on the daily DAX position. So we said leg number one, long call with a lower strike. So let's just take, for example, this one here, 17,780. Of course, I'm paying quite a high premium because for being a long call, I'm already having some intrinsic value. I'm already in the money because I am buying the right to buy at a strike which is lower than the current market. All right, so for this, I would be paying per point 65 or 66 roughly in premium. Be careful, we have 5 per point as a standard, so it's of course, if we have one contract, it's 5 times this this premium that we would be paying. So let's place this first of all. Then the second leg is a short call with a higher strike. So we know the long call we set at 17,780. So we're going to search for a higher strike. Let's take 17,880, 100 points higher, and let's collect via a short call the premium 16.3. Again, that's per point times 5 would be the overall premium that you would be receiving. Important here to say, the short call always has to have a higher strike. So this is how you generate this spread, basically. And the way I look at it is usually for the higher strike, I check, okay, what is my assumption where the DAX is not going to reach to? How high or not higher will the DAX go by the time of the expiry? So let's place this deal as well. Let's look at those two lines that we've created, which build our bull call spread strategy. We have here the long call, and we have here the short call with our two different strikes. And here we see the premiums we paid and received for now. Let's look into a couple of calculations. We will check what are our net costs or also our max loss, what is our maximum profit, and what is our break even. I'm going to show you the formulas also here. I just put them into a Word document and we'll calculate them together as well based on this example. So let's do that here. Net cost or also the max loss in the end here is the premium you've paid for the long call. So that's 65.6 minus the collected premium. And we're always doing this in a per point, €1 per point. You can, of course, then multiply it yourself, but that's the easiest here for this example. So minus the 17.5 that I received for my short call. So my net cost here being 48.1. Okay, first one calculated. Then the max profit. The max profit is the higher strike, which is at 17,880, 17,880, minus the lower strike. So we're calculating the spread here. Minus 17,780 gives us 100. And now we deduct our net cost. We say minus what we calculated before, minus 48.1. So our max profit is 51.9 per euro per point. All right, last one, the break even. So here we take the long call strike, so the lower strike. Again, that was 17,780, 17,780. and we add our net cost, because that's how much the DAX has to rise, the level at least it has to reach in order to break even before we get into positive zone. So here plus our 48.1 net costs. So we know the DAX has to reach this level first in order to be break even, in order to make up for our net cost, because again, we collected less premium than what we are paying. So here, just to wrap up, a bull call spread benefits from two factors: a rising stock price and a time decay of the short option. A bull call spread is the strategy of choice for you when your forecast is for a gradual price rise from the lower strike to or from the market price to the strike, the higher strike of the short call. So in this specific case, it would be up to 17,880. There again are of course more possible strategies that you can use, but here just one for you to monitor. So of course, by expiry time, I hope that this is going to be profitable for me. Don't forget, you always start with a loss because you are paying a spread, which is visible here. And yeah, let's move on. I see that there have been no questions so far, so hopefully everything was clear here. What I want to show you lastly, and I'm going to quickly switch my profile in order to see that as well, because we only show it in live environment and not in demo space, is the so-called digital 100. You see that above options, and maybe some of you have clicked into it. We're not really sure what it is. A very brief explanation here. Digital 100s are so-called binary options. So it's basically a question you ask yourself that you can answer with a yes or no, and you take an action. So let's take, for example, again, the indices, and let's take a daily expiry. So there is still some time, and let's go for the DAX again, just to stay at the same one. Here, what you see is the DAX chart. So you have the spot price itself against which one you will make your bet input. The deal ticket here with the so-called ladder. Ladder meaning here you have the different strikes, and here you have the option at the premiums for selling or buying. Buying, you pay the premium, selling, you receive it. So what do you do now here? All right, you're going to look at your underlying, the DAX, with an expiry in roughly 6 hours, because that's also when we're going to start to reach market closing of the DAX. So in 6 hours, that's where you're going to base your decision on. So what you're asking yourself is the DAX, with the current price being here, in 6 hours, so at expiry time, going to be above or below the chosen strike? So let's make an example. We currently are at 17,806. So we're somewhere in between here. Let's say we're taking a bet. I mean, the overall trend has been a bit correcting. Let's say we assume it to move upward again. So we want to make a bet that the DAX is going to be higher. Let's say we want it to be higher, slightly higher already than where it trades right now. So let's take the 17,810. So here the question you're going to ask yourself: at expiry time in approximately 6 hours, is the DAX going to be above 17,810 or below? If you're answering the question, is it going to be above, and you say yes, you're going to buy the option, and that's the premium you're going to pay. And if you think it's going to be below, so your answer is no, it's not going to be above, you're going to sell it. If you're buying it and you're having one contract in here, you automatically see what your maximum profit and what your loss profile is if you enter into this trade. So of course, your loss profile here in euro terms, not in Swiss franc, so it makes it comparable, is basically those premiums that you would pay. And then you also see what your profit profile could look like. Again, in the info sheet regarding the expiry, here it's a daily one now, of course, but if you look at weeklies, you will have a different expiry date where you can check a couple of details also regarding settlements. Again, cash settlement only. So do have a look. Digital 100s, again, only via the live platform, but via demo, you can also check and trade a bit options, try to use a couple of strategies, see what we have. We also offer US shares here that you can use, FX or also commodities. As said, no physical delivery, so you'll never get gold or crude oil delivered. And in this regards, I am now coming to an end. I see that there are no questions so far. So do feel free to take a second and play something if something was unclear. All right, I think there's nothing coming in. We actually also hit our half an hour. So in this case, I will go back and hand over to my colleague, Julia, for some closing words. And I thank you very much from my side for attending this webinar with us.
Thank you so much, Dunya, for this great presentation on options and how you can trade them with our IG platform. I would just like to let everybody know that this webinar actually came from a client suggestion, so we really do value the feedback that you give in the survey at the end of this webinar. And if there's anything that you would like us to do in the future, please leave a comment and make us aware of that so that hopefully we can do more webinars that are interesting for the clients. And yes, I hope that you all learned a lot and that you had a wonderful time in the webinar. You can stay up to date with our future webinars on the IG Academy, and you can also register for them through our marketing emails, which get sent out. So if you don't have marketing consent on, you might want to switch it on just to be able to access and get notified of the full range of resources that we have available for you as clients or prospective clients as well. So thank you so much for your time, and I hope that you have a wonderful day. At this point, I will close the webinar, so you will see that it will be closed for everybody, and I hope that you have a lovely afternoon, and we hope to see you soon. Thank you.